Okay, so this week we're going to kick off our newsletter talking about rental income. Drew and I just happenstance that this is just a little bit easier to record when we do it on a Teams or a Zoom-like conference call. And we're just kind of getting some general practice for when we meet with other people remotely. We're getting ready. Hopefully, the next newsletter after this one, we're going to do talk to a builder about building costs and just overall construction on the Outer Banks. I think that one will be super interesting. But today we wanted to focus on for our agenda. I'll pull it up here. Is really just about rental income and our market on the Outer Banks, being that it's seasonal rents. I feel like when I've talked to Drew about why certain properties sell or other agents. Rental income is obviously such a significant factor in our market. And I know that for Drew, for example, he's had experience with seasonal rentals and just longer time and history in the business. Uh, so I feel like some of his kind of quick determinants could be helpful for people, determining, how much of an expense the property is going to have with the management company, things like that. One of the things as an example of that I use, I think that's really good that Drew taught me is if you're looking at selling your house or you're looking at the sales price of the home, how much is it going to cost to sell it with the fees from an attorney and an agent. And so, like as an example, in the past, I've talked about this in newsletters where we'll take essentially the sales price, which say the sales price is $1 million, and multiply it by 0.93. And when we do that, we're essentially saying there's a 7% expense to sell it. And therefore, this is your net number before you pay off a mortgage. Or if there was no mortgage, you would net $930,000, right? So just an interesting way to do it that's quick and simple. It's been helpful for me on 1031 exchanges or when I'm talking to people. And so I kind of want to dive in. We're not itemizing every fee when we look at that example of that calculation, but that's kind of what I want to dive into is like, how can people look at a listing? Uh, Typically, the listings say the rental income number, like revenue generated X number. Let's just keep using this $1 million purchase price example. You know, I know some of these answers, but just for the audience and people that may be unfamiliar with the Outer Banks. But Drew, why don't you kick us off on, some of the rental income numbers that kind of what I would call turn heads and make people make uh, an investment decision on buying seasonal rental property on the Outer Banks.
Well, I think we give somebody a good example. Everybody knows that, hey, you got to pay a real estate agent typically 6%, and there's a 1% transfer fee. So you can easily relate if you're a seller or potentially a buyer and know anything about agents and their commissions and what they typically make. That the net price or monies is 93% of that sales price, which is just 7% less off of that number. So it's $930,000 that you net if you sell a property for $1 million. We can use rent sort of the same way in the sense that, historically speaking, your biggest expenses when you own a property on the Outer Banks is taxes, insurance, and your management fee. Those are the three biggies. Everything else is actually really small. Like insurance, I mean, electricity. It's $3,000 or $4,000 a year because it's not open 12 months out of the year. Pool expense, it's an expense and it's substantial maybe, but it's probably still under $6,000 a year. So these are smaller expenses than taxes and insurance and your management fee, which are typically five-figure or $10,000 or more type cost. So so what I do when I talk to folks a lot is, they say they're interested in buying a property. The majority of people in the Outer Banks do want to rent their property. And so one of the questions I ask is, what do you think your gross rents are going to be? So if you're buying $1 million property, historically speaking, if you want the best investment opportunity for it to cash flow, we want a 10% rent multiple. And so a 10% rent multiple on $1 million property is $100,000. So if that property generates $100,000, that's 10% of the total price, and that is an annual reoccurring revenue of 10%, and that's your multiple. But of course, those expenses I just talked about are you don't get $100,000. You got to pay those expenses, taxes, insurance, and your management fee being your big one. But all these other little fees out there that you don't have the answer to what they are because you're looking at multiple properties, you're talking to different agents, you got properties in Hatteras, you got properties in Corolla. So what do you do as just a consumer looking at properties on the internet and on Zillow to try to figure out whether it's a good investment? If it does give you the rental income, there you've got it. If not, then agents will have to give you that. And you really want it on a gross annual basis. What's it generate per year? Not in June, July, and August, because those are your peak months. And those really aren't peak until June 15th. And they sort of go down after August 15th. And so you don't want a weekly rate. You want to know what the total gross rents are. And for what I can do is just look at people's tax returns. And so over the years, I would look at people's tax returns and I'd say, well, they netted X. And as a percentage of gross rents, that's like 35 or 40 or 55% of those gross rents. So when I first got into the mortgage business, taxes, insurance costs less. And so I was using an expense ratio, as I called it, where if you made $100,000, I use 35%, or you get to keep 65 cents on every dollar. That would be $65,000 in this example. Now things have gotten a little bit more expensive with taxes and insurance. I think it's probably more astute to use a 55% number. So that means that you get $55,000 out of the $100,000 in gross rents. So there we go. We've got $1 million property. We want to put 20% down, typically, maybe 25. Some people are coming in with larger down payments with rates being higher. So if we want to calculate, what it's going to cash flow, we just simply, in this case, that we take the $100,000, we think it's a 55% expense ratio. And this expense ratio really works from Corolla to Ocracoke. It really doesn't make any difference where you are. It works with the $500,000 property, and it works with $1.5 million or $2 million property. You get to keep roughly 55 cents on the dollar. A more expensive, really high grossing property, some of these big oceanfronts and wellhead that rent for like $400,000 or $500,000 in a season, believe it or not, those probably might be able to say their expense ratio is a little less because they're generating such high numbers, like maybe 60. But you still have the same percentage can work across the board. That's what I generally find.
Is that when you take, so like you're saying that the property is going to generate, if the $1 million sales price essentially, let's say, was the magic number of 10% rent multiple, so it's $100,000, you get to keep $55,000, right?
Correct.
Is what you're saying. So we get to keep $55,000. Do we have to put that now against the mortgage expense of owning the property?
That is just going to serve as principal and interest. That's the great thing. We've stripped down taxes and insurance. There's no PITI we have to go back. We just have to figure out what is the principal and interest payment to see how the cash flow is on this particular example, this $1 million property that's generating $100,000 a year in rents with a net income to pay for all the taxes, the insurance, the management fee, the electricity, the phone, and everything else. It's, which is $4,583 a month, 55,000 divided by 12. That's what this property is going to be able to pay a payment of each month without coming out of pocket. And you'll have a little bit, not maybe enough, but hopefully a little bit for major repairs or painting or replacing a hot water heater or something like that. And you only have a small amount here, maybe $3,000 to $5,000 for real repairs beyond maintenance. Of course, electricity, phone. Now it's streaming if you're doing streaming instead of cable and stuff like that. So if you finance $750, as a loan amount, $750,000. Let me just run that as a payment, new calculator here. At 6.75%, 30-year fixed. That payment's $4,864. That's not a big. That's a pretty good. That's $4,864.49 versus your income per month on that property is $4,583. You're owning it cheaper than you can own just about any vehicle. That's a pretty good investment.
So let's dive into it because you're moving a little quick. So
yeah,
this calculation right here. So 55 cents on the dollar on $100,000. On $100,000, you get to keep 55K in income.
And that 55,000 is
the just to make sure I understand what you're saying here is that 45% of expenses is what?
The majority of big expenses are taxes, insurance, and your management fee to Twitty or whoever. Even
Airbnb
and VRBO take 6%, I believe. They take a percentage that's not based on a flat fee, but they take a percentage of what you take, and then you've got to, of course, think about cleaning the house every time and everything. So those are your major expenses, and if you think about
this is what the 45% makes up.
That is correct. 45% of this is expenses. You
could almost do 45% expenses are this number, like that, and then you're saying that the 55K of income is solely to pay
principal and
interest.
And if you put 25% down and you finance $750 at 6 3/4, the payment's $4,864.49.
So when you take, I see what you're saying. So this is what your payment could be. This is what
$4,800. Your payment's $4,800, not $4,583. Right? You got $4,583 there, but that's okay. I mean,
55,000 divided by 12 is 4,583 if you do the math. And so that's what you're saying. Your principal and interest can be is up to 4,583 and still essentially have cash flow on the property.
Right. If it was lower than that, you'd be putting money in your pocket. If it's higher than that, you're making the payment. And you've got $750.
What's the payment right here? That's supposed
$4,864 and 49 cents.
Right. I got that right.
Okay, yeah, cool. You do.
So it's basically costing you, just for like a round numbers, like $300 is what it's costing you to own it a month.
I'm doing the math real quick, and it is $281.89. I would be really happy if you could buy property in today's market. That rate works. That's today's rates roughly, and they're subject to change, of course. And it assumes down payment and credit score and all that kind of stuff. We are assuming you have a good credit score, like 780. And obviously, these rates that most of the time, these are second home rates. We're not actually using the rental income to qualify people, which confuses people. They come down thinking they're buying an investment property, and lenders look at it as a second home. And I mean, it's sort of worth mentioning, most of the time we're not actually using the rental income to offset the payment. We're just trying to help the borrower understand what their cash flow is going to be. If you did it as investment, it would be a slightly higher rate. And you only use it from a lender's perspective if the total debts of the borrower exceed qualifying and or really need the income. I don't know how much detail you want to go into DTIs and stuff like that, Alex. Get on a sidetrack here.
Yeah, I mean that's just a long conversation. I'm not really here to focus on all the details of mortgage financing, whether it's a second home, whether it's investment. How they can use rental income to qualify. Lenders don't just make up a number off Airbnb, or, like, for example, just to kind of give some insight, if we have some investors on here, there's a site called AirDNA, and I'm pretty sure Airbnb will do the same, where you put in an address and it'll tell you how much it'll rent for, essentially, right? And I know this is used on some of the rental income projection loans. or has been in the past. But all that stuff online about that, what you can find about rents, they for lenders, they just simply don't use it anymore. They're going to verify it with a third party. And I think that's the one thing I mentioned is that a third party has to determine rents. The lender's not going to determine it. A website's not going to determine. A third party has to, and that third
No,
party
what we're trying to do is just give you some knowledge so you can understand. I'm looking at property. What
exactly.
can I expect for to actually get? A lot of people do come in and go, man, this property rents for a lot of money. I'm gonna, it's got a cash flow. Well, you don't know what your expenses are. You hadn't done it yet. You can get an itemized expense from the realtors once you get into the deal with them, so to speak. But sometimes it's hard to get those. I don't see consumers coming in with those when they're looking. And if you're just looking and you want to figure out what is my cash flow going to be, my suggestion is try to find out what that gross number is, and then you can say, I'm going to get to keep 55 cents on the dollar to pay the principal and interest payment.
Yeah, exactly. And I think another thing to mention that is kind of on the agenda is that the rents here, for example, this little deficit that we have, you see that, Drew?
Mm-hmm.
And
$3,000 a year, right?
Yeah. One of the things that I think that's important is that, and I think a lot of agents would agree, is that sometimes the marketing of the rental property just isn't quite that attractive. They don't have the best photos. They don't have, the proper or like attractive furniture and bedding and things of that nature. And I think with even just like a little revamping of how you market your rental property, you could very likely make up that small number, if not significantly make it up. I know that
in this example, if you're buying it as a purchase, thinking, "Oh, can I make this thing have a positive cash flow?" I think there's always opportunities. Consumers who rent properties don't want to be owners, but they do like sort of feeling like they're in the palace for the week. And so, nice bedding, nice furniture, clean, not old looking. You can definitely do things to improve it. A lot of houses that people will buy don't have a pool. Obviously, you can put a pool in. You probably can do that for $50,000. That will obviously pay. That'll more than pay for itself sometimes. Adding a bedroom. Those are, if you can do that, those are things that you can do to get this property's rents up. I will say that typically speaking, properties that are priced with a 10% rent multiple sell pretty quick because of what you see here. What we more often are seeing right this minute is because prices are high, is rent multiples are probably closer to 8, which would be $80,000. Okay,
that's exactly the objection that we're having in our market.
Right, exactly. and sometimes there's 6, so that's $60,000 on the same property. Well, you still got the same expenses, and the gross rents just are not supporting the price. And this is one of the reasons you're starting to see a little softening of prices or price reductions, because the rent multiples have gotten too low, and they need to be closer to 8% or higher for people to really like it. If they're true investors, you won't have an investor buy a property without an 8% rent multiple. You might have somebody who loves a property buy it with a 6% rent multiple, but they really love the area. They probably plan on using the property some, even in the quote peak season, and so that is for more of the people who just love the Outer Banks and maybe want an investment but don't want to own multiple properties. If you want to own multiple properties, and we have a lot of multiple property owners, you want it to cash flow pretty good.
Exactly. Yeah. And it is I really tried to, in the interview I did with my client, Stuart, I really tried to showcase that he bought the property for other reasons than strictly rental income. I'm just a huge believer that the first reason people tell you typically they want to buy a property is, at least on the Outer Banks, when these investment and rental income scenarios, is the first thing to say, well, I want it to rent well. And then I feel like we're just looking out there for the best property that'll rent. Well, like you just said, most listings are not having the cash flow that are needed, this 10% rent multiple. And if they do, they're gone pretty quickly. And so I feel like that conversation to help not only the agent, but also help the person that's looking for a property. I feel like that transparency of other reasons why you're interested in purchasing is really important. I mean, you just also interviewed Mike Benton, I think it was, and I felt like in that interview there were other reasons other than cash flow that he was buying the property
Yeah,
for.
he's a good example of a person who loves the Outer Banks. He probably doesn't want to own 3 houses here, but he wanted to have here. He likes the rental income and cash flows. It helps us all set. But I don't think he was necessarily focused on a high rent multiple. And we are seeing
Exactly.
more. It is good for the market to get buyers who don't want to rent because that takes property off the rental market. And if they're going to use it more themselves and helps us as we have too many houses to rent, so to speak. I don't think that's really a problem here, that we have too many houses because we have a limited supply of land. And I think that's one of the reasons this market is so great from a seasonal rental perspective. It is a limited supply. And we're close to being really, we're mostly at least 70 to 80% built out, you know?
Yeah, it's interesting. All right, so one last thing because we're gonna keep it pretty short. We've already been on here for almost 30 minutes. Is I know you own rental property that's in LLCs. Um, it's a big conversation for when we're talking about rental income.
Hmm.
Should we title the property in an LLC? Um, you know, my opinion, just quick off the cuff, would be, it's best to have an umbrella policy for insurance. It's where you're going to get maximum coverage if someone's going to come after you and all your assets and other things. And whether you deed it in a personal name or an LLC name, or an LLC being a business, you know, you're just putting a layer of essentially difficulty to find the person, but you're putting a layer of difficulty to find the person that owns it only by a few clicks. And so, if you want to find out in North Carolina who owns the LLC, it's not very hard. So,
No, he's
what
going to get
really
to
are
the North Carolina uh, Secretary of State, and
yeah,
the name because you looked up that in the deed. That's easy to do in the county records. You pull up the name in the Secretary of State's office website, and about 3 or 4 more clicks, you've got the name of the president, which is typically the owner, of the LLC. If it's not,
personally, I'm not the big. I'm like, you're going through a lot of hassle. You got to create the LLC. You have to pay a fee every year to have the business. Um, you're not really providing a significant layer of more protection, in my opinion. And I think the overall solution is an umbrella policy. But not everybody agrees with that, and I understand that. But
well, I
I
mean,
wanted
my
to hear
person,
your take because that's kind of my
well,
take on it.
yeah. So my personal experience is I have LLC. First, when I'm not a big fan of LLCs currently, I do have LLC set up. Would I set them up again? Maybe, or maybe probably not. Um, Honestly, residential property financing becomes cumbersome when you want to take title in LLC. So you automatically limit your options, which means when you've limited your options, you may not get the best rate. That's the first negative about doing LLC on residential property. And the benefit is not that great. It's one of the things that Alex suggested. And I think if you're a property owner from far away, and before insurance got so bad out here, I would take my LLC that I didn't have. I had some property, residential property. It wasn't an LLC, and my insurance company was Nationwide. I bought a $5 million umbrella policy, and I extended that to all my properties. So if anybody broke a leg or hurt themselves, it extended to my other properties. And so I didn't need to have them in an LLC because I had $5 million worth of insurance coverage in case somebody got hurt, died, or broke a leg on my property. And if you're a residential property owner in another state, your insurance is probably a lot less expensive than it is here on the coast because coastal insurance is expensive. People like Nationwide and Allstate who might write in an interstate area or metropolitan area where we're in a hurricane zone will extend these umbrella policies, and you can easily get you can get $10 million worth of insurance through an umbrella policy and extend to a property that you own in another area under your name. If you own an LLC, it's questionable whether they really should be covering it. And of course, if a claim's made and it's titled an LLC, even though you extended that umbrella policy, it's not in your name, the insurance agent might be able to find a way to not pay the claim. So it's really probably better to do it that way if you can for residential property, in my opinion. I do think commercial property is different. I know we're not commercial property financing people, but I do think like commercial buildings probably should be in LLCs. If you have a service business, you probably should have an LLC. If you notice, I got a water ski behind me because I got a business called OBX Wakeboard and Water Ski that I like to do in the summer. Can't fail to mention that I like water skiing. And I have an LLC for that, OBX Wakeboard and Water Ski LLC. If somebody breaks a leg or gets hurt, which is more likely in this type of activity, then you probably need an LLC. It's sort of a high risk activity, to be honest with you, but I like doing it and I take people out occasionally. So, the other thing is it's very, you're not hiding much. And the one more thing I'll say about it, and I'm rambling a little bit, is the best way to do the LLC, in my opinion, and get the best mortgage rates is, if you want one, is to create an LLC to receive all the rents. You don't get the money. The property management company gives it to an LLC company, wires it in. The LLC company that you set up to receive the money also is the entity that signs the operating rental property management agreement with, say, Twitty Realty or Surf and Sound in Hatteras or Brindley Beach or Carolina Design or whoever it might be. I don't want to favor anybody. You can use any of these companies. The LLC is in the agreement with the property management company. They're paying the LLC. You've created a wall that's between you and the renters anyway, and the property management company. And the attorneys that we talked to, Mike Casey and Starkey Sharp, think this is the next best thing you can do. They do agree that LLC title property might be a little bit better than this option, but it's not much better. And this allows you to get the best rates. And there isn't, first, at the end of the conversation, there's not a lot of case law that says having the property in LLC really protects you. There have been claims on the Outer Banks. I don't know many of them. My customers have never brought them to me, so I don't think there are that many, but I do know there have been some on the Outer Banks when I talk to realtors.
Yeah. Yeah. I also think that another point to mention is that if you do the suggestion you just made of entering into the property management agreement with the LLC, you have a lot more flexibility with who can be on the LLC. If you get a loan, every person on the loan in the LLC has to be also on the loan. Does that make sense? Like if you're in the LLC and you're trying to get a mortgage, therefore you have to be on.
You can't limit your liability as far as obligation to make the mortgage payment. You're still signing the note personally and everything. You're just titling it that way. Right. One last thing is they created a new federal requirement in regard to LLCs. And a lot of people really dislike this. Some people think it's a civil liberties issue. You have to give your driver's license, a lot of personal information to FinCEN. That's a financial crimes network prevention department within the bank, probably within Homeland Security. But a lot of people think this is really an infringement. This started effective this year where you had to do this. So every LLC I've got to set up, and I've done this, I had to report to FinCEN and give them all this information and file the report with them. And if you don't do that, you're subject to pretty substantial fines, the feds and all this other stuff. It's not good. They delayed it actually because of the civil liberties concerns, but then they went ahead and pushed ahead and said you better do it. So it's in place. Some people aren't doing it because they feel like it's a civil liberties issue, but it's better to file with FinCEN. If you don't want to file with the federal government and know more about you, you don't want an LLC. And you got to do it every year. It's easy to forget these
Every
things.
year.
I've had to pay penalties because I did not get my LLC renewal done in time. One other thing, I've seen LLCs not get renewed for years and years and years, and it's titled that way. So the title is that way. You go to sell it, you'll have to go back and pay the past due LLC fees, reinstate the LLC before the attorney will let you actually close it. I've seen that happen.
Yeah. What I was trying to explain is that if you have multiple partners is a lot easier to do with your recommendation with the lease solution versus having multiple partners on a mortgage. Multiple partners
Mm-hmm.
on a mortgage, generally when LLC titling is occurring, is most of the time very difficult. Most of the time.
Right.
Versus if you have multiple partners in the other solution, it's not nearly as difficult.
Right.
Okay, well,
I hope
think that wraps
this
it
was
up.
helpful for folks. We're just trying to give you information. If you want to talk specifically about a property or call us, we'd be glad to talk about it. We'd love for you to like our channel. We're trying to have a little bit of a podcast format. We are right at 30 minutes, so we probably want to wrap it up. But I want to. This is Alex's idea today to do this topic, and so I did this from my home here in Southern Shores just because that way he didn't hear me echoing next room over. And he's in my office or our office there at the beach. And we'd love to have you come see us.
Yeah, sounds good. We'll go from there. Talk to you next
All
week.
right. Thanks a lot.